So, Brian, you're in banking. There's been no shortage of news about banking over the last month, starting with Silicon Valley Bank, Credit Suisse, the earnings, including your earnings, which came out about the last quarter, was very strong. So now that we are where we are, looking back over it, what do we take away from it? Was this a banking crisis? Was it a mild disruption? Was it a tremor? What was it? What is going to linger from it?
Well, I think in the end of the day, a crisis is too strong a word, and words like that get used a lot. But at the end of the day, there was a fair amount of disruption for a few weeks there. Well, certain business models were sorted through, but on the other hand, you could see, and we could see, the stability in the other business models, which were the way banking is done, granular business and stuff. And so the good news is you're seeing the earnings by the broad industry come out this week. You're seeing things have sort of played out that way, which is very specific business models because of unique circumstances of the last 24 months or 36 months of massive amounts of cash put in the system, and then rates changing caught people, and those had to be sorted out. The good news is the basic industry has reported good earnings across the board. Deposits have come down, but that's intended by the Fed taking money out of the system. It's got to come out of somewhere. Banking system is what they want to do to, frankly, make credit tighter and help slow down the economy. So that's gone on. But you look at the capital, liquidity, and the earnings power of all these companies have been tremendous, and that's reassuring to people, and that's good news because in the end of the day, the banking system reflects the economy in America and economies around the world, and you hope it's in good shape, and it is. There's no question it's good shape.
How'd the regulators do? Were you talking to them through this period of time? And they stepped in, obviously, particularly the deposit insurance. And do you think they should be making changes for the future to make sure we don't go through this again?
I think there'll be a time to look at the deposit insurance scheme in a rational way. It's never the time to look at any of this stuff the day after it happens because people have opinions of what happened. It never turns out to be as true as they thought. And even in the financial crisis, there are a lot of opinions about it started with Lehman. Well, that was the last part of it. It started in 2006 when what happened? Housing prices quit going up. And so, so it took a little more rational thought to think through all the different things that happened. So I think, the debate will be for transactional accounts, should there, during the financial crisis, 2008, 9, I think going on for three or 4 years, there was a guaranteed transaction accounts. So the individual smaller companies didn't have to be cash managed every day and figure out where the money was. And, that's a scheme you could do. There's sort of transaction money in the banking system, there's savings money in the banking system. And the savings money in the banking system is there to get rate and return. The transaction money is there to help the economy going. And the idea is you can ensure that more fully, and that's what they did in the financial crisis to stop people from figuring out. In the end of the day, a scheme like that would have changed the nature of what went on here because people were running around trying to figure out was there $250,000 in one in a small business or an entrepreneurial thing or a big company even. And so I think there'll be time to talk about that. We'll see it play out. It's worked pretty well. I mean, at the end of the day, the industry pays for the deposit premiums. We insure ourselves. The government is the go-between to make sure people believe it's there. And they get the money back from us. And so this, we just had our earnings, and we said our deposit insurance premiums before this went up $100 million per quarter from last year to this year. So I think we're $2 billion a year plus, and so we insure it. And so this is nice because the banking industry pays for its own heirs, and then we have a high instinct to clean it up. And so I think playing with the thought process ought to be carefully dealt with only because it's been in place since the 30s, and it's worked pretty well.
Your bank and some others stepped in with First Republic to help them out with some deposits, led reported by Jamie Dimon. Is that something we should expect in the future? I mean, is First Republic going to need more, or will other banks need more from the other banks?
I don't have any special insight about First Republic. Talk about why we did as an industry. It was to stabilize one of our companies and provide liquidity because it was a liquidity question. The assets were good. This is kind of the odd thing because if you're around, if any of you are old enough to be around in the late 80s and 90s, that is when the banking crisis went on. People think the GFC, so-called, was a banking crisis. Actually, the issue was those companies weren't banks. So whether it was all the different companies you heard about that caused trouble, including they weren't banks, and they were brought in the banking system, put an umbrella around them so they could fix them. In 08, in the late 80s and early 90s, you had a highly inflationary, high interest rate environment of commercial real estate, and that was a banking crisis, and so that's different, and it happens at a slower pace, and so we were able to step in and help because that was an asset quality problem in the 80s and 90s. Commercial real estate, rolling real estate started in Texas, and oil and all this stuff. It just ran through all the regional economies. These companies had great asset quality. It's just they had a liquidity problem, and that's why we put the deposit in, and it worked.
Tell us about deposits, because there's a lot of focus on deposits these days. You have massive deposits, last time I checked, really big ones.
Yep.
As I understand it, your deposit level is down a bit, although it's up from pre-pandemic. What, if anything, have you learned about the stickiness of your deposits from all this? A lot of reporting about that out of Silicon Valley Bank.
Well, there's a lot of reporting about it, but the backdrop is the deposits in the industry pre-pandemic are up 30-ish%. Our deposits are up 34%. It's only 3 years. This is the U.S. We don't grow that fast. So this is the nominal economy is up 25 or 30%, not the real economy, but the nominal economy. So what happens is, money got shoved in the system, the nominal inflation came out of it, but that's what grew. So the deposits are up on a rational basis. When the Fed has to, when the system has to unwind, first fiscal stimulus stopped and now monetary stimulus, the deposits will come down. That's unusual because deposits in the industry have very rarely ever gone down, but there has never been as much monetary accommodation shoved in the system as fast as happened this time, so they've got to bring it back down. That's what you're seeing. The industry is drifting down. And we're 1.91 at this quarter end, 1.93 at year end, 1.93 a quarter, and so it's bumping along at that level, which is $500 billion more than we had during the pre-pandemic. And we think, based on estimates we make, it's performing exactly as we thought, which is that is really the extra size of the economy reflected through one of the biggest banks in the country and our peers. And so, it'll work its way back down, but it's much slower. It was a quicker pace and slowed down. Where's that money going? Into the money funds. Cash is yielding 5%. That's not exactly economically energizing activity to have people put their money in cash. That's what the Fed's trying to do, is trying to slow down inflation. Once they break that, the rate structure will come down and the money will move back to do work. And after a period of time, the economy will catch up to the size of it.
Are banks at an inherent disadvantage on their business model? In this sense, you're funding by demand deposits that people, by definition, can pull whenever they want. You're putting into long-term assets, that are long-term, as opposed to some of the private credit outfits who get locked up capital for a long period of time that they can match with the assets. Do you have an inherent mismatch in the deposits versus the assets?
Well, and we manage that. That's why we have outcome management and a team of people, and that's managed to maintain the balance and that sensitivity. So up 100 basis points, we make $3 billion more in NI, and down we make $3 billion less on a base of $55 billion a year. So it's a little bit of movement of money, but that's how you balance it, because the entire balance sheet moves and everybody looks at certain parts of it in this part. So it's the way you manage money. So our consumer customers, I don't know, 80-odd% of the balance have been here, customers for 10 years plus. And even on our commercial side, same thing. All the balance of people have been in relationships for a long period of time. These customers have been around for decades, decades and decades in some cases. And so they're very stable. It's just a matter of the ebbs and flows of the rate environment will change the profitability. But you say, is the business model flawed? There's only 4 companies that have made more than $15 billion in America in the last 8 years in a row. 2 of them are banks. And so I don't think the business model is flawed.
You reported some nice growth in net interest income in your last report of earnings. At the same time, you mentioned the money markets. You're competing against some people who are paying higher rates. Are you going to have to pay more for those deposits? Is that going to cut into your net II?
It does, except for the assets move too. So so our net interest margin actually grew. Has been growing over the last year in dollar amount and percentage. And the toughest time for us is 0 rates, because we have all these great people, hopefully are clients of our company out there, and thank you if you are. We have your checking account balances, and we can't charge you for those. In other words, we're not going to, in certain economies, they will say, give us $100 in your checking account, we're going to charge you, we're going to give you less back and negative interest rates, so-called. We don't do that here. So the toughest time for us is when rates are really low, because guess what? The floating rate loans we have are also low. When they expand, they more than covered up. So we went from maybe our NI went up, 25% year over year, first quarter, due to that phenomena. The rate structure went up. The zero interest deposits are always zero. The other interest deposits go up that we pay interest rates on in the commercial side and the high net worth side and the consumer side. And then what happens is the margin as a result of those two, and that margin expanded from, I think, 160 to 220 something basis points. So.
What about what you do with those deposits? You said 1.93, is that what you said, trillion, something like that?
1.91, yeah.
1.91 trillion. Do you have ways to make that money work for you? And what I mean by that is, where are you on loan demand? Are people demanding loans? Do they want the money at this point?
Yeah, loan demand is, so now you got to step back and think about what's going on. You have an economy which has a higher than desired inflation rate, and so they've raised rates. So what does that do? That stops loan demand pretty quickly in the mortgage area. So mortgage production, was something $14 billion a quarter, 5 quarters ago, and it's like 4 now. And that shows you the difference in terms of just, it stops it. Cars become more expensive because the payments go up. Therefore, you're seeing car sales slow down. But that's all new activity. The historical balance and stuff, are there. So I think, that's on the corporate side. You have sort of the capital markets oriented companies and the leveraged finance markets, things like that, have been kind of screwed up for a while now as rates rise until they settle in, and that goes on. They settled in a little bit in January, February, and then we had the fun in March, and that changed it. So, but overall, loan demand is mitigating. The economy is slowing down. The Fed tightening is having the intended impact. So our loan growth for the quarter was, 4, flattish. It had been growing, 10%, last year during the, on a given quarter. That is really that loan demand slowing down.
And so where do you put the money to work? Is it a challenge for Bank of America as you have the deposits that are holding up, as you say? You got to do something with those deposits. I mean, at some point, do you put it into Fed excess reserves? Because they pay you a nice amount of money, is the last time I checked.
We put a lot of it there, and that's having the effect that they want to do is that money goes outside the system and basically either holds treasury bonds, either treasury bonds at the money market funds or bills, and then or gets deposited back in the repo program at the Fed. Is kind of so it's taken out of the productive economy, and then the rest of it we invest in non-risk assets, treasuries or mortgage backs, and that's the investment portfolio.
There's been a lot of reporting about the extent to which we have losses on the books. Certainly we had Silicon Valley Bank, but also about Bank of America that haven't been marked to market yet. Where are you with respect to long-term treasuries?
Well, we mark on, this is the AFS portfolio is marked to market. The held to maturity is not. The mark's been going down. We haven't made any investments in held to maturity since the middle of 21. We basically, because we had all this excess cash, we put it to work and we've just been letting it run off. And that's the style we take. So that it's $1 trillion we have to put to work every day that the loan demand doesn't take up.
Wow,
so it's got to go somewhere. If it goes into no return, then we can't make any money because a deposit doesn't earn you any money, and the activity to support the customer behavior is cost. To let you have access to all those ATMs and phones and digital and mobile and all that stuff. So the way you make money is you put it to work. If you can put it to work on loans, that's always superior. There's only $1 trillion of loans, so all the rest of it has to go into basically short-term and long-term.
Tell us about your trading. You did very well in fixed income, as I recall.
We did. Dimmy and DeMar and the team did a great job. They're up. I think we're one of the few companies that was up year over year in the quarters, and I think second or third highest best they've ever had. And the teams, we invested more in that business. And they've done a good job, and using the Bloomberg terminal as well. They made some money.
There's a nice plug. Last one on Bank of America specifically, headcount. I think you were actually. You're projecting you're going to be down something like 4,000. Is that attrition or is that a systematic reduction in force?
It really, so, and the colleagues here are a lot of tech people, and imagine last year versus this year in terms of, you had to grab any human being that you could hire last year at this time. It was a great resignation. I mean, you're smiling, but it was true. This year it's completely different. And so our attrition rate has dropped in half. The problem was last year when we had that attrition rate, whether it's Aditya Bhasin in the technology developments or our Tom Scriven in our processing areas, our branch teammates was 50-some thousand people. We were hiring, and we hired 38,000 people last year, 22,000 in the last 6 months of the year. We only grew heads 8,000 people. This year so far, we'll hire. So far, we hired about 5,000 people, and we're net down heads. and the attrition slowed way down. And we'll probably only hire about 10 or 12,000 people this year, and the headcount will come down. That's how fast you had to turn the engine on and then turn it off. And when you have half the attrition across 60,000 people from 10 or 11 to 5, 6, think about how much less you have to hire. That's good news for the company because that's a lot of inefficiency to get people up to speed. But it was pretty remarkable. So we started at 216 at year end. We had 3,000 teammates, largely in technology development. We had to come after year end because we were stepping up our investment from about $800 million a quarter to $800 million a quarter to $900 million a quarter. And so we had to have those teammates to come and do the development work in the first quarter. 3,000 came on, and during the first 3 months of the year, we ended up flat. And by the first 2 weeks of April, we're down to 500 people, and we'll drift down. And it's not, we're not laying people off. It's just the attrition allows you to manage it. But we would deploy people. If you were in this job, we ask you to do that job. If you don't want to do the job that's available in the company, that's a different question. But we're trying to do everything we can because it's the right thing to do for the teammates because we want them to have a career here, which means they'll have different jobs. So this will be a time we'll give them a different experience.
So let's stay on tech since you raised it at this Sell-Side Leaders Forum. Brian, as CEO of Bank of America, what role did tech play actually in the Silicon Valley Bank? Because we've had people like Steve Schwartzman, like Larry Summers said to me that the ability to just sort of do a bank run on your phone has made a big difference. Did it?
It probably did, but that's not new. We have 60 million consumers. We have 35 million plus mobile active customers. We have 45, 50 million digital customers. It's across all the businesses from mass consumer to affluent consumers, the businesses. They move literally, in the commercial side, digitally, they'll move trillions. You can send $1 billion off your watch. I mean, it's pretty amazing. So that's all a phenomenon that exists. But customers don't independently move money by the device. They move it because of who they are and what they're doing. That's the piece that's lost here. So did it facilitate potentially an easier execution? Yeah, but you could have executed that way a lot of other ways. And that may have had a change of 24 hours or something, but the people would have moved. When you step back, the more interesting question really is how it will be sorted out that way, but we don't see any real difference. We see tremendous digitization of our customer base, but I'm not sure I'd go there as much as I'd think hard about, in the end of the day, everything's gotten easier for life, and this is just one of those trends.
So you've been an early adopter of a lot of technology for Bank of America in various ways. What's the biggest game changer for Bank of America when it comes to technology?
I think it was a smartphone. And so those of you who are aficionados of the history will go back and look, and you'll see when when Apple announced the iPhone, you'll see that one of the few outside apps was a Bank of America app. And because instead of going to, for those of you around that time, the way people did to you, so Verizon, at the time, I'm not sure they were even called Verizon, but they would come and say, we have our cell phone, and we'll bet on it a piece of software, and that can be linked to your banking app. And by luck or smarts, and we can always debate that, but it's good to have a little bit of both in the team, not me. We basically had a web app, a browser-based app in the old language. Well, guess what? We're the only person with it. And if you want to demonstrate this new fantastic product, how do you do it? We took off. We had maybe a couple million people using it, and we just exploded with a smartphone. And then it was how do you make that feature functionality better? And then how do you keep driving it? And how do you keep changing? And so, so that was, but it was the ability to have that, that amount of computational capacity in the pocket, the ability to have it, had the networks, which were pretty bad then and a lot better now, the ability to react with us, and then the ability to actually fulfill behind it. And so, that was the infancy, and it's taken off. And so when you speak to Erica, which is a voice-activated artificial intelligence, predictive language engine with a special language built because there wasn't one that existed for financial services 6, 7 years ago, and has 18 million people touching it a day, when you talk to it, and say, what's my balance? First, I'd understand that you weren't asking about a yoga class, which was part of the challenge, right? Then it has to go find, or what's check number 642 in my account? It has to go find that check. Your 35 million checking customers, all the transactions that were done, and think about that. And by the way, you could be driving a car at 60 miles an hour, hopefully not driving, but you could be in a car. There's 110 systems behind that mobile system. that are feeding it. So it's the combination, the smartphone enabled, that's the breakthrough that just changed everything. You had a computer in your pocket and all these specialists way beyond that. But what really enabled it, as you forget, is the network capacity and delivery. What really enabled it was the ability to pull the stuff out of the systems and the data arrays that we had to have. All that is interesting. Otherwise, you just have a fancy way to get to our website, right? You had to have a way to actually go and find transaction X or transaction Y. Then Eric, you could lay on top of it. Then, mobile check deposit could lay on top of it. Then, Maggie you could lay on top of it. You had to have that basic connectivity, and people missed that. So it was the size of networks, the speed of the networks, the pace of networks, the availability of networks, the uptime of the networks, because people didn't want to have it not go through 5 times in a row and be frustrated, because guess what they did when that happened? 1-800 Bank of America. And so, and they call you, and then you have call, so it had to really work, and the team's done a great job from that start till now. But that changed everything, because it democratized computer ownership, computational capacity ownership to everybody, and also made it mobile in a way it wasn't before. Laptops were mobile, but it was a pretty clunky experience. So.
As the head of Bank of America, you have an almost unique insight into the American economy, and specifically the consumer. I know you said that March over March, consumer spending is up. At the same time, you're taking more provisions against possible some losses on some line. What does that tell you about what's around the corner? Are you seeing the end of the spurt in consumer spending?
So three different topics. One is consumer spending in March was up 9% over last March across all the different forums. In April, that slowed down a little bit. We'll see how it ends up, but that slowed down. It was slower in January, February, picked back up in March. That means the consumer's still doing things. They're traveling. It's a lot more travel, out the home experiences, so-called theaters, et cetera, concert tickets, sporting events, everything's going strong there. When you look at April, you're seeing it slow down a little bit. The debate's going to be, is that due to some of the tax timing and stuff, because that's changed this year. We'll see it play out. But the consumer's in good shape. They have more money in accounts than they did by the pandemic by multiples, especially with lower stratas. The ones that don't have it are the wealthiest consumers on our platform, because they put the money first in the market, now in the money funds. So they have money. The credit quality, our charge-off rate this quarter was a number which is about a third under where it was in 19, to give you a sense. But that's a 53-year low in 19. So the credit quality is unbelievable. And so that's good news. Are we putting up provisions? Yeah, because we keep planning on this recession. It seems to always be out there that we haven't gotten to yet. But and then the third thing is the consumers have capacity to borrow. So the usage of our lines of credit on the consumer side, home equity loans are down from 30 billion in outstandings to 20 billion outstandings during the pandemic, and the card lines are down from probably 100 and some billion down to about 90 billion. They were down as low as 70. They come back up. So there's plenty of borrowing capacity for consumers. So that means the consumer is going to be there and they're employed, which means the job of the Fed is tougher. And that's why the Fed has to be more resilient, because the consumer drives the U.S. economy, and the consumer is still in the game, and the consumer is still employed, and we're paying our colleagues and teammates more than everybody in the room, and then they have money in accounts and they're spending. And that's not true for every single human being in America, but the average is true that way.
One last question, Brian. You are the chair and CEO of Bank of America. You've gone through a lot of experiences to get there, developed a lot of experience as well as expertise. What has helped you the most, and will the next generation CEO of Bank of America draw from the same skills, or will it be different? Are we going to have an engineer? Are we going to have a data scientist?
Well, I'm not sure. At the end of the day, you got to be curious, and I think whether it's myself, I tell myself that, or whether I tell the teammates that when they ask me the question about what, and you just have to keep assuming you don't know anything, and ask questions and get smart people, and then be able to judge what they're telling you and figure out how to do it. And that will be the trait. That type of trait will be the trait, because if you don't run the company. We have 200,000 plus teammates. They run the company. The 20 management team members run the company. But you have to be curious. You have to think about what's going on. You have to try to learn. You have to learn from other people. You have to learn how to absorb different types of inputs. There was point in time way back in my career when I almost became the head of technology, for example, and I had no skills to do it. But what I could do is, the people told me at the time they wanted me to do it, and I told them there's probably a better idea here. But it was because they said, well, you can get people to work together and think, and that's what the traits, I think, of a good leader in a company have. So you got to be curious, you got to keep learning. But I'm not sure the next CEO of Bank of America has to be an engineer, has to be a data scientist, has to be a trader, has to be a consumer banker, has to be a commercial banker, has to be an investment bank. It can be any of those things, but they always realize no matter where they came from, they got to have an ability to absorb and learn a lot of other things, and that's by asking questions.